As my business grew, my counterparties grew from individuals to multifamily offices on the buy side to pools of capital, much like Scott's, to investment firms like Scott's, to very large pools of capital like BlackRock and Fidelity and T. Rowe Price. And at that point, Battery East was born to marry the largest and most sophisticated pools of capital with growth stage companies, their founders and investors. And that's what we do. We closed our first deal. We're a 4-month-old firm. We closed our first deal on December 30th. It was an $80 million primary round for a leading ad tech company, which is going to be followed by a $30 million secondary and tender offer program. Also something that is sort of new in the space. Again, a company-sponsored program for employee liquidity.
Great. So I'm Scott Halstead with Revelation Partners, and what we do at Revelation is provide liquidity to owners of private healthcare companies. So all we do is healthcare, and all we do is look for and interact with shareholders who own a stake in an interesting healthcare company. So those people could be founders, they could be angel investors, they could be venture funds, they could be hedge funds, they could be corporates. Any institution or individual who owns a stake in a company who doesn't want to wait out the normal cycle. And what I mean by normal is usually they get their liquidity by either the company is sold or the company goes public. And what we're really offering is a third option to either one of those, where, again, an institution or an individual can get liquidity for some of their shares or 100% of their shares, depending on what their interests are, and we can provide that liquidity.
Interesting. Scott, can you talk a little bit about the profile of the kinds of companies that can do this? I mean, do they need to be a certain size to make sense? What are sort of the most dynamics?
Yeah, so it's a good point. As a general statement, individuals like myself and funds like us like to see companies that are at the later end, they're later stage, they're further along. What we do that's different from traditional venture capital investors is we're trying to put up 85–90% of our money day one. We will invest in companies after we own a piece of them, but we want that to be a relatively small piece of what we do. As opposed to traditional venture investors, maybe as little as 30 or 40% of their capital they put in day one. So if you think about what that means, it means that my fund and funds like mine are focused on later stage companies that aren't going to need to raise a lot more capital, and therefore they're
But these are still venture type deals? I mean, are they revenue generating or not? Or?
So I would say there's two types of deals in the healthcare space. There are the revenue generating deals, companies doing anywhere north of 5 or 10 million in revenue, or certainly candidates. And then there's the other type of deal, which is a company will clearly be able to get to an exit event, usually meaning M&A, if they get an FDA approval or complete a certain trial or something like that. So that if the key is that we as investors can see how this company could get liquidity in the next 24, 36 months. And it may not be revenue generated, it may be clinically driven.
An example of a deal that Scott and I both worked on, Scott and I worked on together with we on the sell side and Scott on the buy side, was a company that was both. It was just ahead of an FDA approval. It had meaningful revenue in Europe and Asia. It's a device company, but no revenue domestically. So, probably past that binary outcome that often you find in, healthcare device space of it's going to happen or it's not. Had meaningful investors in it, sort of top tier venture, top tier strategics.
How much had gone into the company, do you think, at that point?
At that company, there was about $120 million in the company. So two things were going to happen. Presuming FDA approval, the day after the FDA approval, bankers will come in and sell that company for some multiple of its last round, or beginning the day after FDA approval, that company will decide to go raise $250 million to commercialize the product and then go public, a year or two later.
So Scott, your fund was an investor at that?
This is a deal that we worked on together.
Yeah. Okay. Yeah, and I think one way. An important overlay to this is it isn't necessarily just purely providing liquidity as the only reason these transactions happen. Quite frankly, that's usually less than half the motivation. What I mean by that is take examples as we see often in today's environment, where a lot of very good healthcare companies have taken a little bit longer and a little more money to get to the right place. As a result, they have two kinds of investors: the early guys who have been in now 8, 9, 10 years, and then the guys who have only been in 3 or 4 years. And you can get friction between those two groups as to how much more money they want to put in the company, do they want to sell the company or finance the company, all that kind of stuff. And so we'll come in and try and solve that problem by providing some or complete liquidity to the early guys, so that they don't apply as much pressure to the later guys to try and get out early. And so in situations like that, quite frankly, the starting place isn't the early investors want liquidity today. It's more of they have a different strategic view for the company. And by being able to provide a little cash in that equation, you can sort of make the engine run a little smoother.
Is there sort of a name for this type? Is it like a mezzanine fund? I mean, is there a term for this?
Secondary direct investing is the most common name.
Or secondary market liquidity. In this context specifically, in the live example you gave, was a founder who had left the company, lives in the Bay Area, had been earning a normal low six-figure salary from the company, had 95% of his net worth tied up in this company, and wanted to sell 20% of his stake in the company to buy a home. And that's very, very common, in sort of our context, as historically we've represented individuals, now we represent companies and individuals, but those individuals, it is often a bedrock liquidity event that they're looking for to put, to take some chips off the table and literally almost always buy a house.
So would you consider yourself a private equity fund focused on late stage venture deals in the healthcare business?
We do, because the way I describe it is, if you think of as a company as a house, your traditional venture capitalist or private equity guys kind of, what I describe, walk in the front door, and we walk in the back door, meaning how we get in. But once we're in the house, nobody asks us how we got there or what we do. So what I mean is, once we own a stake in a company, we act just like a traditional primary investor. So before I did this, I spent 20 years at Morgan Stanley in their Morgan Stanley Ventures doing nothing but traditional late stage investing. And what I do today is no different from what I did then. The only difference is how I got into that house or that company.
You guys talk a little about the structure of these deals. I mean, and to what extent this approach can work for smaller firms that, maybe 4, 5, 10 million has gone into the company, maybe a little more is needed, plus some people early investors need to get some money out. Like, what are sort of the fundamentals of the structure and the legal documents and the due diligence? Can you just frame that a bit for us?
Go ahead.
It depends. It's a little bit case by case, and as Scott can talk to, there are very few funds like Scott's. It's very much an emerging area, but funds like Scott's have a lot of different structures they can use, including a loan, including a straight purchase, a combination of the two. From a document perspective, it's fairly straightforward. There's a letter agreement between the buyer and the seller. There's some sort of notice to the company of, I have intent to sell. Here is my intent to sell. Here is my buyer. Here, I am this person who's the seller. That goes to the general counsel. Often there's a ROFR period, a right of first refusal period by the company. That's usually 30 days, where the company has the time to process that and decide whether they want to take that deal down at the same price. Either the company buys the stock itself, the company has a capital partner that is that they've designated to handle these types of transactions, or they source that capital partner from an existing investor outside, or the company says, none of the above, we'll let this deal go through, and that purchaser takes down those shares and now owns a part of the company.
So is it like what was happening with Facebook and Second Market, and they were sort of was that a similar kind of transaction?
Yeah, it's a similar kind of transaction. What was happening there, that was a little bit of a phenomenon and fundamentally a bit of a melee in that, those were transactions happening completely outside of the company's control. There was a bit of the stock option documents, to be very specific, in Facebook for early employees did not account for curbs on a secondary market because they had no idea that a secondary market would occur. So a lot of people who worked at that company, hundreds of people who worked at that company and had vested stock, had the opportunity to sell those shares. And so this whole market emerged to buy this stock, and the company kind of just had to process these requests as they came, and if they decided to exercise their right of first refusal and let a capital partner buy the stock, they would. But some of the transactions were done at such a high price that the capital partners were like, I'm just not paying that, so you have to let the deal go through. So what ended up happening is Facebook had a problem where their cap table, their capitalization table, the number of shareholders they had, started to get really big. And at that time, this is before the Jobs Act, there was a threshold of 500 investors on a cap table that said if you have under 500, you are a private company, you do not have to report. If you have over 500, begin acting like a SOX-compliant public company. And you'll now notice the Jobs Act allows for 2,000, not 500. That was largely sort of the lobbying efforts of the shares posts of the world or second markets of the world. But what we're kind of exploring and talking about, these are smaller companies generally, there are fewer shareholders, they're sort of more bespoke transactions, and most importantly, they are, generally speaking, company-blessed transactions. Because at least on the buy side, on our buy side, we have no investor who will buy a stock without having an engagement with the company, a dialogue with the company, generally access to a company data room, financials, access to management, et cetera, whether it be a $5 million or $200 million investment.
So just comment briefly on the structural. So as I mentioned before, particularly in the healthcare world, which is very different than the IT world in this space, often the problem goes beyond just a shareholder wanting to get some cash. There's another problem that needs to be solved, and therefore structure fits into that. And what I mean is a simple deal is where a shareholder just wants their money. That's real easy to describe. Here's $1 for your shares. I take your shares. We're done. That is less than 50% of what we do. It's probably less than 30% of what we do. Much more common is a situation where we'll do, which is what's really happening is there's 4 investors in a company and one of them doesn't want to or cannot participate in the financing that's going on. We'll go in and we'll not only buy their shares, but we'll also put money into the company to sort of make the whole system work. Because the company doesn't really care whether this guy sells his shares or not. What they want is money for the company. And so we'll do those kinds of deals. We'll do deals where we'll look at a portfolio of 5 or 10 healthcare companies that, let's say, a venture capitalist or a hedge fund or somebody owns, and we'll just do a straight senior loan to them. We'll go in and say, here's $15 or $20 million. It's collateralized by these assets that you own, by these companies that you own, and we'll get some sort of preferred return out of those. Just one more example, just to give you a flavor, all different ways. There are other situations where we've gone in and just said, you have $90 million, Mr. Venture Capitalist, invested in 6 or 7 companies, and you need another $20 million of follow-on capital. We'll just provide the follow-on capital and work out an economic structure. So it's really just about any structure you can think of. So it's a
custom-built kind of program.
Very much.
So shares post and second market kind of moved into this area, and we're a lot of visibility and obviously second market. I understand that there's a change in their business models, and can you comment on their experience and sort of what they're doing now and why they're maybe changing the models?
You'd know more about that.
Sure. So, I'm not intimately involved with either of those companies, but I know them decently well. So Shares Post emerged as a bulletin board, a platform for individuals who wanted to sell stock to be married with individuals who wanted to buy stock. It was not an institutional platform. The sort of classic, there's a dentist in Boca who wants to write a $250,000 check to buy shares of XYZ technology company. They would do that over Shares Post, and Shares Post would be paid a fee of, call it 8% on that transaction, charging the buyer and the seller. They did that for a good amount of time, mostly around Facebook. That went public. They struggled a bit, I think, and then changed their platform through a deal with, they had 2 divisions. But they still do brokerage of those types of deals. They no longer have that bulletin board, fundamentally. I think there was a lot of technology behind that bulletin board, and with that technology and a large database they had of these buyers, there were like 100,000 of these, individual buyers. did a deal with NASDAQ, who is trying is trying to go earlier and get access to earlier companies,
like
fundamentally.
a feeder system for
It's
their
right.
listing.
It's a farm team for listings for the NASDAQ. So that's where they are now. They do not do that anymore in terms of the sort of the matching of
So
buyers
why
and sellers.
did that not work? Or
I thought it worked fairly well in companies like Facebook, but as companies, in technology companies specifically, have battened down the hatches in terms of their stock options agreement documents, disallowing that type of transaction, or making it much more difficult. The market is just right up. It's become
so
structurally.
companies don't want to do those.
Well, I think a big difference, again, between the IT and the healthcare world, which is shares post worked well for companies that were momentum plays. The
Correct.
Facebooks, the
Correct.
Twitters, the Groupons, the Zyngas.
Correct.
All those guys where there didn't have to be a lot of due diligence. You know,
Right.
I could post on the bulletin board that I want to sell my shares at $1, and somebody bid 90 cents, and we'd agree on 95, we were done.
Right.
Very, very different in the healthcare world, where you typically don't have these momentum plays where you say, well, the company did 200 million in revenue last year, it's doing 500 million this year. What more do I need to know?
Right.
Healthcare world is different. You need, obviously, to get much more into the science, the technology, the clinical data, and all that. That's why the bulletin board model doesn't work as well in healthcare.
Interesting. So one of the ideas that we've been floating to people is this notion of a vertical market in the healthcare business, or accredited investors only, sophisticated in healthcare, who are interested in quality deals. The Jobs Act has opened up the whole flow of information, so now a doctor somewhere can actually see deals that he could never see before because he may not have been part of the network club or the venture. You just had no access to those deals. And where the notion is that this liquidity premium, which is the same identical company, public versus private, is going to be worth more because you actually can trade your shares, that they can begin to capture that liquidity premium by some limited level of liquidity, and they've got, it makes it a little easier to raise money because you go out and get a private investment. These things, as you know, can take many, many years, and at some point you need your money back, and that difficult conversation where one of your most loyal shareholders has been there forever, says, gosh, Scott, I need 50 grand, can you help me out? What are your thoughts on the pros and the cons of something like that, and that as a way to help make companies raise money a little faster and a little easier and maybe at a better valuation because they're giving some level of control to their shareholder to get some liquidity at some point, at least on some structured basis?
Yeah, my comment, I mean, there's a lot of, you could talk for hours on the whole topic, but relative to this panel, secondary, how does secondary fit into that? I'll just focus on that. My one comment would be there is a pretty meaningful difference between when the company is raising capital for its personal uses versus a shareholder seeking liquidity.
Right.
The whole process, how it sets up, who's involved. So when I buy stock from a founder or a venture firm, the company is sort of over here on the periphery. They're a piece of it because they have to know what's going on, but they're on the periphery. Very different than what you just described, which is XYZ company wants to raise $10 million on your platform. There, the company's going to take management meetings. There's going to be in-depth due diligence. There's going to be all kinds of discussion of what am I doing, a preferred stock, a common stock. They're very different worlds when the company's raising it versus just an individual or an institution trading in the secondary.
And you're onto something in terms of there's momentum around that idea. NASDAQ private market, which is, was the old shares post, is fundamentally that. It is designed as a more formalized marketplace for companies to list, to raise capital. The NYSE invested in a company called Ace Portal. Again, a similar analog to that, where Ace Portal is a place where, through an investment firm like us, a company can list, or we can do capital raises to, a discrete group of investors whom we say to, go to the other side of Ace Portal, log in, and you can see our deals, or where we can go to Ace Portal and say, look, can you open it up to your larger universe of investors because we want, we also want to target these other 10 companies or the other 10 firms. We don't have a relationship with them. You do. Help us access this these pools of capital as well. So there is momentum around that on the company side. On the individual side, it's, that market has, at least in technology, is a bit drier. I'm not aware of a technology that exists right now for individuals to sort of post their stock. And the one caveat I would say is every company is different in terms of their docs, and the means by which those individuals acquired that stock, assuming that they're a founder or an employee. Investor is different. There may be restrictions on that employee or founder's ability to sell, and as such, for a buyer to actually hypothecate that stock, to take ownership of that stock.
Right. What impact is the internet going to have on, I guess, your businesses and in general? We have had a couple of excellent panels on crowdfunding, this notion that a lot more investors now can learn about deals. Is the internet going to play a different, impact this whole notion of these secondary markets in any way?
For us, no, because again, what's key to, so we're generally not buying $50,000 lots from angels and stuff. I mean, we're typically doing $5, $10, $25 million deals with sophisticated owners on the other side, which means, that's not going to be a transaction there isn't enough information flow that will be allowed over an internet type of platform to allow that kind of capital to be deployed. I mean, we're going to go to the company, we're going to take do management meetings and all that kind of stuff. So for us, that element doesn't really play into it. It might be different for your platform.
Yeah, no, it's fundamentally the same. Our investors are institutional investors as well, and while we are technology enabled as a firm, meaning we may be creating a private data room that exists in a cloud that our investors with access that we grant to them can log into to gain financials and pipelines and what have you on our client companies. It's but for the internet we couldn't do that. But
I mean, frankly. That's almost 3 steps ahead of, at least 3 steps ahead of where this market is. In the healthcare world, again, different than IT, yeah. The biggest problem that I face when I talk to people is 80 to 90% of the people I talk to, again, angel investor, institutional, do not know that this exists as an option, that they can even access or think about getting liquidity. The mindset is that company has to go public or get sold, and that's the only way I get liquid. Everybody I talk to, I spend all of my time educating them that there's this third choice. And so to jump ahead to where your discussions or questions are rightfully going, which is can you take friction out of the system and make it more perfect and get better pricing and all that, is really years ahead of where the healthcare world is right now, where most people doesn't even occur to them that they could sell their stake in XYZ private.
So how many firms do kind of what you do in the healthcare business in terms of come in late or,
So we know of only one other fund that does what we do. And there's differences between us. They focus more on med tech and stuff, but really there's only one other fund that we know of that focuses solely on what we do.
It's really early in this space. And so, I had a conversation, I was telling Scott, with a leading venture capitalist in the healthcare space at one of the largest acquirers of all things healthcare all the time. When we were talking about a deal that he had invested in and said, look, a founder is interested in getting some liquidity. He said, great. He said, let me put it to you this way. This is a kamikaze plane. We're all strapped into this plane. We're bolted down and we're going down together, and I will be damned if that person gets $1 of liquidity before I do. And he said it sort of tongue in cheek, but the point is that the aesthetic in IT around founder liquidity, even when venture capitalists come in a C round, maybe they'll buy $5 million or $10 million worth of stock from a founder. In the case of Zynga, the founder sold $100 million of stock in some of the later rounds of his own. That's just beginning in healthcare. So the notion of early liquidity is I think going to happen in a few years. I think Scott's a really early firm in this, doing this on the buy side. It's something we're starting to do on the sell side. But Scott's right, there's a ton of education that has to happen to the companies, their investors, founders, that this is an acceptable practice and there's a way to do it in a way that is company friendly and kind of can meet everyone's needs from a win-win perspective, as opposed to,
So it's part of the issue that, I want all your chips on the table. If you're running this company, you're selling some shares, is that a bad sign? Are there some of those issues around?
Yeah, in the one transaction where where we are providing liquidity to an existing manager, CEO, CFO, somebody like that, that's always a topic for discussion.
Yeah.
Again, that's probably only 15% of what we do, so it doesn't affect a major part of our market, but if you're in those situations, yeah, that's a major part. You know, the other venture capitalists sitting around the table, just as he was indicating in the story, don't want the CEO taking meaningful capital off the table before they get their money out.
Right. Well, it seems like a great service that you are developing to, and I would think the venture guys would gravitate to you pretty quickly because they want to get out of these deals, right? And they want to get more fresh money in, typically.
You keep rolling the analogies to IT, but in the healthcare world, particularly if you talk about the venture capital, which is where most of the money that went in over the last 10 years has come from, a lot of those firms are not going to be raising funds going forward, and so they're, the tail end of their lives, and they have to find some way to get liquidity. And many of those will be able just to ride out the cycle, and their companies will either sell or go public. But many of them are being forced by their limited partners to seek liquidity much earlier. Say, your fund's 10 years old, you got 5 companies left. We, the limited partners of your fund, aren't willing to wait another 3 or 4 years. You got to sell that stuff by, you got 9 months.
Right.
That stuff's starting to happen.
So what advice would you give to an entrepreneur who's getting his corporate structure organized, his shareholder agreements, assuming that you want to position him to have a sort of an efficient execution and be able to use something like what you guys are doing without having to go back and rewrite agreements and have clawbacks on provisions and just make your life miserable? I mean, what can you do structurally to be set to use a vehicle like you guys provide?
So, we have this conversation often with counsel for those companies, the early stage, the sort of Wilson Sonsini's of the world and the Fenwicks and Cooley, the larger technology serving and IT serving and healthcare serving law firms. And we ask them to ensure that the stock options agreements that they're issuing contemplate a controlled secondary market that is sort of company sponsored, and that there are appropriate stopgaps put in there that the company can put in place to curb a secondary market that might get out of hand, essentially, cancel transactions that are not approved by the company, et cetera. And that's happening more and more. So what happened after Facebook, again in technology, was there was a pendulum. The pendulum swung all the way over. So literally, there were Facebook employees who sold, call it $20 million of stock in a secondary market, went on to found companies thereafter. And the companies they founded completely disallowed those employees who built those companies from having any stock sales. And so you had, it caused fairly significant ill will on the part of those employees. And when this company starts to do well and they've been there 4 years and would like to get some liquidity but stay at the company, that the pendulum is starting to swing back to a middle, to where, as we've seen, again, in technology, some of the very largest capital partners in the world, clients of ours on the buy side, a Fidelity coming in, wanting to write a $50 or $100 million check to a company that is 2 years from IPO, the company doc should allow for that type of transaction to occur, much like BlackRock did in Twitter, where they became the right of first refusal partner to Twitter. They bought a bunch of common stock from employees who were exiting. So it went from many shareholders to one new shareholder, and then they wrote a big check to the company for primary capital as well. And when, not that Twitter needed this, but as an example, when Twitter is doing its IPO roadshow, BlackRock is a major shareholder, and that's validation to the public markets that you have a huge capital partner who is a public market investor, not a private investor, who is going to support you as a public company for the interminable future.
There are also many analogies here that can be used in the public market. I mean, the public market is basically a liquid market, and there are lots of controls there where you have programs selling by senior managers. You have windows at which management's allowed to sell. I mean, a lot of those tools that have been used for eons in the public markets can be applied to this market as well.
Right. So the key gets down to the stock option agreement or the shareholder agreement, and organizing to decide, are we going to let you sell your shares to some third party, and if so, a first right of refusal back to the company?
It's also, you know, something, it can be more nuanced than that. Something called there's a SEC rule called the tender offer rule. And something that we as a firm do is we manage tender offer programs for companies. So a company will say, look, we're 6 years old, we're probably not going public for another 3 years, but we have employees itching for some liquidity and we'd like to provide that for them, but on our terms. So we run a tender offer program for that company where you bring in a or multiple capital partners, you establish a price over a period of 20 days. You then do an offering internally for the employees to say, look, you can opt in, here's the price, you're allowed to sell X number of shares dictated by the company. Often it's, you know, somewhere between 10 and 20% of your stock, or let's say an upward bound of $1 million worth of your stock. And it's an orderly process. Those employees can opt in or not opt in. And if they choose to opt in, then, you know, at the end of the period, they get money and the buyer writes one check and acquires that stock. So that's a fairly new concept that, you know, even some of the largest investors, the, you know, Kleiners and what have you, aren't super familiar with. And we as a firm help manage those and kind of walk companies through it.
Wow. Sounds like you guys are doing some pretty innovative financial strategies. So it's kind of cutting edge stuff. It
is a very emerging market, and you are sort of, for two reasons, as we described before, you're trying to match the solution to the problem.
Right.
It drives towards customizing every deal, and then a lot of what Barrett was talking about, where you have all these dynamics going around about between investors and existing option holders. And so, yes, it is a pretty dynamic world in terms of how you structure these things.
We have a time for a couple questions. Does anyone want to? I've got one. As investors in these kinds of companies, what do you look for when you're looking at making an investment in a company in terms of their structuring? I mean, how deeply do you get into those financial structures, and do you like to see something like a tender offer situation organized, or existing, anything else that you would like to see? And what do you like to see?
Yeah, so I would give a couple comments. One is we've focused a lot in the discussion here about sort of the individuals who tend to be the option holders and their liquidity. Again, in the healthcare marketplace, quite frankly, the vast majority of the dollars, I'd venture 85% of the dollars, are with institutions on the other side, venture funds, hedge funds, guys like that. So it isn't the founder cashing out, the option holder cashing out a la Facebook. That market just hasn't developed yet, quite frankly, in healthcare. 85% of the dollars are, we're buying Boston Scientific's position in the company or XYZ Venture Fund's position. So that's one part of it. So a lot of the structural stuff we're talking about that hasn't yet really applied in healthcare. The other question is, what are we looking for? What we look for is, as I described before, once we're in the investment, it doesn't matter how we got there. So we're looking for all the things a typical investor is looking for, you know, good business model, good IP, good all those kinds of elements. And the key thing in today's market in healthcare is syndicate risk going forward. That if the company needs more capital going forward, that there's enough people at the table to support that company. Because the biggest risk today in healthcare that didn't exist 6 or 7 years ago is the company needs another $5 or $10 million and nobody at the table has any money to do that.
Interesting. Gentlemen, thanks for joining us today. Truly appreciate it. Let's give them a hand.
Thanks.